Assalamu alaikum students. Let's move on to a new chapter, chapter 9, that is inventory costing and capacity analysis. Without wasting much time, let me go on to the chapter header. Let's note that this chapter focuses on two important topics. The first one is inventory costing, and then we'll talk about denominator level capacity. So, inventory costing basically is a costing system that is chosen that is chosen to determine which manufacturing costs are treated as inventoriable costs. So, our focus is going to be on the items that is classified as inventoriable cost when we prepare the income statement. While later we will be discussing about denominator level capacity, where we talk about the choice capacity level choices, like the company need to decide what level of capacity they need to operate on. So we talk in this part of the chapter, we'll talk about how does a company choose the level of capacity with which they would want to operate. Moving on, let's talk about inventory costing. So basically, there are two methods which we'll be discussing throughout this chapter, though we talk about some other methods also. But basically, in this chapter, we are going to compare between two methods of costing specifically for inventory purpose. The first one is called the variable costing method, where under this method of inventory costing, we take all the variable manufacturing costs, whether it is direct or indirect, under the inventoriable costs. This method is also known as the direct costing method. So what we would do is, before we would want to find out the cost of the contribution margin, we would be taking all the variable cost, regardless of whether it's a direct or an indirect cost, into the income statement. The second method is called the absorption costing method. Here, this method of inventory costing, where you would only consider the manufacturing cost as inventoriable cost, while all other cost which is non-manufacturing would be considered as a period cost in the income statement. So we can say that the inventory absorbs only the manufacturing cost under absorption costing, while under the variable costing, the inventory absorbs all variable cost, whether it was manufacturing or non-manufacturing. To explain this further, we'll go to the next slide, but here there is also another concept called as throughput costing, which I'm going to discuss a little bit later. So let's go on and talk about the inventory costing method. We're going to say that depending on the method of inventory costing that you have chosen, your income in your income statement would appear different. That means your operating income will be different depending on whether you have chosen the absorption costing method or the variable costing method. Secondly, depending on the inventory costing method that you have chosen, the amount of difference would represent the amount of fixed manufacturing cost that has been capitalized as inventory under the absorption costing method, or expensed as a period cost under the variable costing method. The third aspect is that if the inventory level changes, that is, if you change the level of inventory, then the operating income between the two methods is going to be different, because you have a difference in the accounting for the fixed manufacturing cost. So at different level of capacity, your inventory cost would be different using the different methods. To demonstrate that, let's have a comparative look at the income statements prepared under the variable costing method and under the absorption costing method. Um, let's look at the variable costing method. This is the method that we have used when we prepared our budgeting in chapter 6 and chapter 7. So you will notice here that the income statement is prepared by considering revenues minus all variable cost of goods sold. By that I mean you're going to take all the variable manufacturing costs as well as all other variable non-manufacturing costs, of course after adjusting for your inventory. So we would say revenue. I could highlight that again. So revenue minus variable cost of goods sold here would give you contribution margin, and then you would deduct all the fixed cost, whether it is manufacturing fixed cost or non-manufacturing fixed cost, to get the operating income. And remember, this was the same method that we used when we prepared our flexible budgets, or we did our budgeting chapter. Uh, while I look on the right hand side here under the absorption costing method, you follow your normal uh, income statement as we have seen in chapter 2 onwards. So it's revenue minus cost of goods sold. Please note here that the cost of goods sold is considering the manufacturing cost, whether it is variable or fixed together, so that it gives you the cost of goods sold. So you would say revenue minus cost of goods sold gives you gross margin minus the non-manufacturing cost, regardless of whether it is variable or fixed cost, to give you your operating income. So basically under the absorption costing method, what you do is you use this technique. You say revenue minus cost of goods sold is equal to gross margin minus period cost is equal to the operating income. While if you remember, under the variable costing method, what you would do is you would say revenue minus variable costs gives you contribution margin minus fixed cost, that would give you your operating income. Of course, if you will notice here, you will find that the amount of operating income under both the methods, as you can see this number, would not be the same because of the way in which you're classifying your cost. That is, you're considering under the variable costing system, you will be considering all the variable costs as inventoriable cost, while in the absorption costing you will consider only the manufacturing cost as the inventoriable cost. Let me move on. So when we talk about, I mean, here is an example that if you take the variable costing method, or maybe you take the absorption costing method with the 2 years of figures. Again, I think this figure is not very clear on the screen, so you could go to your textbook and you will notice here that year by year also you will see a variety of changes as you are taking both this method of costing. Comparative income effect, that is, if you take variable costing method or if you take absorption costing method, what are the main differences? So maybe this slide could be considered as important, specifically for your consideration for the short answer question. So you can say that the question that you could ask while you differentiating between the variable costing and the absorption costing. So if I'm considering the question, are fixed manufacturing cost inventoried? So you will notice that fixed costs are not inventoried under the variable costing method, but yes, they are inventoried under the fixed costing method as long as they remain manufacturing cost. The second question that we can ask to differentiate between variable costing and absorption costing is that, is there a production volume variance? So definitely in the variable costing method there will not be a production volume variance because all the variable cost is considered as inventoriable cost, while in the absorption costing method there would be a production volume variance. The third question that we can ask is, are the classification between the variable and the fixed cost routinely done? In case of variable costing, yes, we do classify the cost as variable or fixed, but in case of absorption costing, we are not more concerned about classifying the cost as variable or fixed. Rather, we are concerned about classifying them as manufacturing cost and non-manufacturing cost. The other question that you could ask, or we can say the elements of differences could be because of this. Here, I would want you to notice this part as important. So you will notice that when the production is equal to sales, you will find no difference between the variable costing and the production costing income statement. Why, I mean the operating income. While in situation where the production exceeds sale, in other words where you have a higher level of inventory, then you will see that the variable costing usually provides a lower operating income as compared to the absorption costing. The opposite is true when the production is less than sales, mean that when you have a lesser inventory, you will see that variable costing provides a higher operating income while the absorption costing provides a lower operating income. So this can be an important item for your study, specifically for the assessments. What are the effects on cost volume profit relationship for the given level of fixed cost at given contribution margin per unit? So if we are looking into this aspect to differentiate between variable costing and absorption costing, you will see that the variable costing is driven by unit level sales. So you consider the cost of a cost or the price per unit, while in the absorption costing, it is driven by the unit level of sale. It's also driven by the unit level of production, and then basically it's also depending on the chosen capacity level or the denominator level that has been considered. So this slide could be important when you are talking about the differences between um, variable costing and absorption costing, specifically in relationship to the income effect. So let me move on to the next slide. Here we'll talk about absorption costing and performance measurement. Here we'll think about why exactly do you need these two different types of inventory costing method. So basically we need to understand that absorption costing is essential for our financial reporting purposes, and basically uh, when we prepare our financial statements according to the financial reporting standards, most countries require that you follow the absorption costing method. This is also preferred because of other reasons, like it's more cost effective and also less confusing than variable costing method. It can help managers to take action by considering their performances. Basically, the performance measure may look good, as you could have seen from the previous slide, but then it could hurt the income if they report it to the shareholder. So this is very important. Basically, you will see that maybe the company has really performed well, but then if you report it, it may hurt the financial statement. And basically, the third reason could be that it measures the cost of all manufacturing resources, regardless of whether it's a variable or fixed. So for producing the inventory, it's not only the variable cost that gets affected, but also the fixed cost. So that's another reason why absorption costing is less confusing than variable costing. However, we'll also see what is the importance of variable costing in the upcoming slide. So we could say that if I'm looking at the negative aspect of absorption costing, you will notice that one unfavorable attribute of absorption costing is that it leads the manager to increase the margin. So sometimes it's also possible that the managers may increase the margin and the operating income, whereby it can produce more ending inventory. For this, I would like you to go back to that slide where we were looking at the difference between variable costing and absorption costing. And you must have noticed that whenever there is higher inventory, absorption costing shows a higher operating income. So whenever the managers are tempted to show higher operating income, they may end up producing more than what they sold, and this could lead to more ending inventory, which may not be favorable for the company. The next challenge, or we can say the next limitation of absorption costing, is that normally if the companies produce for inventory, maybe it can be justified in the cases of rapid growth in sales if you're forecasting it, but then you should not simply take this up just to boost your profit. So that is why this could also be a challenge, that if the manager ignores this aspect, they could end up with a lot of inventory which may be useless and which may even lead to inefficiency in a company. So what is the solution? To reduce an undesirable buildup of inventory, companies usually use variable costing instead of absorption costing, specifically for the internal reporting purposes. So if it has become compulsory for the company to use absorption costing for external reporting, then the company may use variable costing for internal reporting purposes. So let's go on and we talk about how the companies can reduce undesirable effect of the absorption costing, so the management can actually focus on careful budgeting and inventory planning. That is one aspect. So though we know that absorption costing can lead to unintended increase in the inventory, but then with careful budgeting and careful inventory planning, this can be avoided. The company has to incorporate some internal carrying charges for keeping the inventory. By carrying charge, we mean the cost of keeping inventory. We know that if the company increases the inventory, it is not free of cost. They need to spend money on keeping the inventory, the warehouse maintenance, etc. So basically, if the company is forced to also allocate some carrying cost into their income statement, this type of behavior of the manager can be avoided. Thirdly, you could also change the period to evaluate the performance. Basically, if you keep the annual performance evaluation apart and then allow the managers to have a performance evaluation maybe based on any other cycle than annual cycle, you will see that this type of behavior can be avoided. And finally, when you're doing performance evaluation of managers, make sure that you're not keeping only the financial aspect but also include some non-financial aspect. For example, you could in addition to considering the operating income, you can also consider some other ratios like beginning to ending inventory ratio, or any other ratio like a number of units produced divided by the number of units sold, so that the managers avoid taking advantage of the um, limitations of absorption costing for maybe misguiding their investors. I will talk about another level of variable costing, which is called as throughput costing. Now, throughput costing is sometimes called super variable costing, where basically you would be considering only the direct material cost as inventory cost, and all other cost is treated as a period cost. Now, in a throughput costing, what you would be doing is you're going to do revenue minus only direct variable cost, and that would give you your throughput margin. Okay, and then of course minus all other costs, so we call them as period cost. All other cost is considered to be the period cost, and that should give you your operating income. So you will notice here that this is a more refined version of variable cost, where you're not taking all the variable cost as inventory variable cost, but you're only taking the direct variable cost. So in a throughput maybe income statement, you will see that only direct variable cost is considered as inventory variable cost, and all other costs are added to the period cost. So throughput margin is equal to revenue minus all direct material cost of goods sold. So you can see maybe a format of throughput cost illustrated here. So here you could say that revenue minus direct material cost of goods sold, adjust the inventory of materials, and that should give you your direct material cost of goods sold, and you got something called as throughput margin, and minus all other manufacturing and non-manufacturing costs to give you the operating income. Of course, the numbers are going to be different yet again, whether you're taking across 1 year or across multiple years. So overall, if I'm going to compare the costing system, notice that in absorption costing and in variable costing, basically what is taken as inventariable cost. In case of absorption costing, direct manufacturing cost, variable direct manufacturing cost, variable um, indirect cost, and then of course variable indirect manufacturing cost, fixed direct manufacturing cost, and fixed uh, indirect cost or overhead cost. All of this is taken as cost in absorption costing, whether you're following the actual costing method, the normal costing method, or the standard costing method. However, in the variable costing, you do not consider the fixed direct or the fixed manufacturing overhead. You only consider the variable aspect of this. So finally, we can conclude that inventory costing um, we can conclude the inventory costing discussion, and in the next slide we are going to talk about the capacity level aspect of this chapter. So we'll talk about denominator level capacity. What does that mean? Basically, when we prepare maybe our income statement, or when we want to report our performances, basically we consider a particular level of capacity, or we consider a level of units at which a company or a firm performs. So spendings on fixed manufacturing cost enables the firm to obtain the scale or the capacity that is needed to satisfy the expected market demand. Now, determining the right amount of spending, specifically in terms of the fixed cost or even in the variable cost, will tell us the appropriate level of capacity at which the company is actually operating. So we'll talk about this as a very important we can say decision which the managers need to make. That is, at what level of capacity should a company operate at. For that, we'll talk about a few concepts here. We'll talk about the challenge that the manager would face, that is, too much capacity means the firm will incur the cost of unused capacity. Now let me give you an example here. Imagine that the firm has a capacity of producing maybe 10,000 units, and uh, imagine that the firm can only sell 5,000 units. So what it means is that a firm which is operating at a capacity of 10,000 units is having 5,000 units, which is unused capacity. Now when we say unused capacity, basically you may have purchased a machine which can produce 10,000 units, but you're never going to use it. So that means you are actually wasting your investment by having some unused capacity for over a long period of time, which could lead to inefficiency. On the other side, if you have too little capacity, for example, let's say your customer demand is more than 10,000, but then your capacity is only 10,000. So it means you are having too little capacity, and then you are not able to meet the demand of of your customers. This is also harmful, because then you are not meeting the demand, and then you are losing the opportunity to fulfill the demand of your customers and make profit out of that. Thus, for the manager, defining a proper level of capacity becomes very important. Don't you agree? So with this topic, let's go ahead and talk about the various capacity levels that the managers need to define as they operate in their businesses. So we could say that the choice of capacity level that's used to allocate the budgeted fixed manufacturing cost and produce and to the products, so after they are applying the operating which can it can greatly affect the operating income. So there are four different capacity levels which can be defined by the managers, or which can be used as a denominator level to compute the budgeted fixed manufacturing cost rate. By fixed manufacturing cost rate, I mean the total cost divided by the number of units to be produced. So there are four levels of capacity. The first one is called the theoretical capacity. Then we have the practical capacity, the normal capacity, and finally the master budget capacity utilization. So let's talk about each one of them one by one. So let's first talk about the theoretical capacity. Theoretical capacity is the maximum or the capacity at if the company operates, what could be the capacity at which it can operate at the fullest efficiency at all times. So if that's the maximum level of capacity which the company can operate in. But we need to understand that the company will never operate at its highest level of capacity, because they have to make allowance for some slowdowns in some production, or maybe to acknowledge some bottlenecks, or maybe some maintenance, some shutdown periods, or maybe some interruptions, because of which you may not be able to achieve the highest level of capacity, though you have the ability. So in the real world, theoretical capacity levels are not attainable because of the reasons that we just stated, and so they represent the ideal goal capacity utilization of the firm. Rather, we could say that this is the capacity that the company aspires to achieve, but of course, they don't achieve it in reality. So the second level of capacity is called the practical capacity level. So this is the level that has been defined after deducting all those unavoidable operating interruptions that we have already discussed, maybe like the maintenance, holidays, shutdowns, and so on, so that you could be fairly appreciable of this level of capacity being able to you will be able to achieve. So normally, after considering the engineering and the human factors, what capacity have you been able to arrive at is called your practical capacity level. Usually, how do you measure the capacity? So you may be measuring it by using your supply or demand. So we could say that both your theoretical capacity and the practical capacity can be measured, can be measured in terms of what a plant can supply. So we come to the third one, that is the normal capacity utilization, and the fourth one, that is the master budget capacity utilization, which usually measures your capacity not in terms of what you can achieve, but in terms of the capacity level that you will actually be using, because this is what is the demand for your product. Okay, so we could say that the normal capacity and the master budget capacity utilization is derived based on the demand for your output from your plant. That is on based on what your customers are demanding. So it is possible and even likely that the budgeted demand will be below the production capacity, as we saw from our theoretical and the practical capacity level. So theoretical and the practical is what you try to attain, or what it is that you prepare yourself for, but what you actually produce is depending on the normal capacity utilization or the master budget capacity utilization. I hope this topic is clear. So let's define the normal capacity utilization level. So we can say the normal capacity utilization level is that level of capacity utilization that satisfies the average customer demand over a period of time, and that is long enough to be consider the seasonal, cyclical, or any other trend factors. And the master budget capacity utilization can be defined as the level of capacity for which you have made the plan for the upcoming period. I'm sure you remember what we mean by the word master budget, isn't it? So master budget is the plan that you made at the beginning of the period. So exactly, if I'm considering the master budget number of units, then that is my master budget capacity utilization, which I'm going to consider for the next one period. So here is an example. So if I'm going to consider all my four capacity utilization levels here, you will notice that the theoretical capacity level would be the highest, followed by the practical capacity level, and then maybe the normal capacity utilization, and finally your master budget capacity utilization would be the lowest among the four. So the choice of the capacity level can have a huge impact on the budgeted fixed manufacturing cost per unit, as you could see here. In the last in the last column, you will notice that if you produce more and more, your fixed cost per unit would be less and less. That's the reason why, if you are choosing to operate at the theoretical capacity level, your fixed cost per unit would be the lowest, while if your budgeted capacity is the lowest, then your fixed cost per unit would be the highest. This is something you can note from this slide. So let us go on as to um, what are the reasons for which the company is going to choose the denominator level of capacity. These are the reasons. The first one is maybe for the product costing or the capacity management. Secondly, maybe for making their own pricing decision. Thirdly, for performance evaluation. And fourthly, for external reporting purposes. Of course, the fifth aspect is for tax requirement. For product costing and capacity management, using practical capacity as the denominator level will set the cost of capacity um, at the cost of supplying the capacity, regardless of the demand for the capacity. What this means is that if I'm talking about considering my capacity level for product costing, then I wouldn't be considering the demand for my the demand or the supply of my capacity at all. Finally, highlighting the cost of capacity acquired but not used by the direct managers, because then you have to consider the unused capacity also. In contrast, if you are either considering the capacity level based on the demand, then what happens is you hide the amount of unused capacity. If I'm using it for the pricing decision, then yes, we need to note that this is one of the best choices for the making the capacity utilization decision. So you're going to have a downward look at your demand, which will be important for your company, and so you will note that it's going to help you in comparing your prices with your competitors, and then you could keep an eye on what's happening to the number of units that you are spreading, because the more and more number of units that you sell, or more and more number of capacity that you're going to keep, you can spread your cost over more and more number of units. And if your demand drops further, then that means your cost per unit is going to be higher and higher, because your fixed cost per unit will be spread over fewer number of units, and so it could lead to a greater cost per unit for you. When we consider the practical capacity in contrast, then you will notice that it is a more stable measure, because then you're calculating something after considering your normal maybe inefficiencies, or maybe the normal capacity that can be used to meet the demand. If we consider the capacity utilization for performance evaluation, then we need to consider the unused capacity also, because unused capacity actually adds to the cost of production, because you're preparing yourself for a higher level of operation, but you're not operating at that level. So mid-level managers have no control over these costs, but they do have control over the prices, so they can do the adjustment in that way. Whether the manager should be held responsible for manufacturing overhead costs, that is unrelated to their potential customer. Now this is something where you need to make a decision about whether you should apply the practical level capacity or the master budget capacity utilization. If there is a large difference between the practical capacity and the master budget capacity utilization, remember master budget capacity utilization usually is the lowest level, then you need to use that to plan your unused capacity. Now finally, if you remember, this is the fourth reason why you will be using the capacity utilization, that is for external reporting. Of course, if you're using this capacity utilization level for the external reporting, then basically you have no control over it. However, you will notice that your favorable or unfavorable production volume variance under absorption costing is going to affect the choice of your denominator level, that you're going to use to calculate the budgeted fixed manufacturing cost per unit. Okay, I'll just uh, skip that. So we could say that for external reporting purpose, you need to note that why are you using this capacity utilization rate becomes very important, because as you have to develop the budgeted fixed manufacturing cost per unit. If the reason was the tax purpose, then we could say that the IRS is the Internal Revenue Services. This is the tax authority in US. It permits the usage of using practical capacity to calculate the budgeted fixed manufacturing cost per unit, and then it also allows for you to write off any production volume variance that is generated because of this. So, so in this case, the tax benefit can be significant uh, as IFRS allows you to deduct the losses that you have made because of the production volume variance. There are some other issues which we can also have a look at. First thing is the difficulty of obtaining the demand side denominator capacity, denominator level concept. So though we say that the master budget capacity level would mainly depend on the demand side, because if you remember in the master budget chapter we said that your master budget begins from your revenue budget, meaning that first thing you have to do is identify how much is the demand for your product at the end of the upcoming period. So then it is very difficult to obtain the demand side denominator capacity, and also it's very difficult to forecast how much is going to be the fixed manufacturing cost per unit or the total fixed manufacturing cost. So then again the difficulty arises, and finally we could say that the capacity issues for non-manufacturing parts of the value chain is also very difficult to analyze. So if a company is using ABC costing, that is activity based costing system, then it's very important that the company should identify what is the capacity level for each cost driver. With that, we have ended this chapter. Thank you very much. I hope it was useful.